Brad Williams, Frugal Finance, stock volatility. What is that? What does it mean? I'll explain it. It's pretty straightforward. It's the teeter-totter of the stock market. We have the ups, we have the downs. This is from FINRA, a great resource. I'm going to discuss just as simple as possible the variability of stocks and why they change. If I knew why they change, I would be reporting from my yacht. Other than the fact that there is considerable sentiment. In other words, we have professional traders that are moving trillions and trillions of dollars in and out of the market based on way too many variables for me to discuss here to keep this a rather short and concise video. With that being said, let me just give you an idea. I am going to go over to Yahoo Finance and just show you the S&P over the last year. Up here, S&P 500, and you can see it's up $37 this morning. And here's your volatility. Excuse all the stuff here. You see where it dropped here, and then it went up, and then I'll try to do it this way. Well, you see the variability here. This is not a very good resource. This just gets in the way. So you can see right here, the market was at a high, then it dropped, then it went to a new high, then it dropped, then it went to a new high. And you could see how crazy this market is. The beginning of the year, it was at 48.41 and it's up to 6,130. And you just take the differential there and you're going to see there's probably a 20, what's that, divided by 4. So that's just an absolutely crazy return. Is this sensible? Well, I have my opinions, but I'll keep my opinions to myself. This is all about volatility. Why does the market do what it does? Because it could be earnings related. It could be interest rate driven. It could be purely sentiment. It could be macro environments and micro environments. Individuals are paid millions and millions of dollars to come up with rationale as to why the market does what it does. I've been doing this for nearly 50 years, and I have a good handle of what the market does and why it does it. But I used to do the day trading. I used to trade options. I used to be a registered rep. I used to be registered with the Commodities Exchange, so on and so forth. So I have a lot of knowledge here, but I just don't understand the markets today. There are some factors that go into play, and that's common sense. And when common sense is thrown out the window, and it was thrown out the window just post-COVID pandemic, and the market has gone straight to the moon. Why? Well, there are variables, and the variables are supporting the market. In other words, you see this inflationary component that we're dealing with? This inflationary component is passed to you in terms of higher prices. And then in turn, it improves the profitability of companies. So as you as a consumer continue to buy, you're pushing up this market. You can either go, I don't get this, or I can do one of two things. If I can't beat them, I'm going to join them. So that's a lot of the sentiment there. And then in terms of understanding some of the verbiage that we use in the industry, we have a beta. And a beta, if you look here, I don't think it'll show here. If we go, we'd have to go to something like, let's do Apple. And it's not a good, probably not a good example. But if we go to the fundamentals here, you're going to see the financials. We're going to look at statistics. And then if you look here, you're going to see maybe what's called a beta. And they have enterprise value, trailing PE, blah, blah, blah. And this is all stuff that you may go, what is all this you're talking about? This is all price related statistics. And then here are some fundamentals. There's a big difference. And what I'm trying to find here is the beta, and it should be 1.24. So if the market goes up $1, the beta of Apple should go up $1.24. That's probably a bad example, but there's a volatility here. 1 means it's tracking the market. And if it's 1.24, there's going to be more volatility with Apple. And that comes into play if we go to this chart. And if we overlaid the S&P, I don't know why there's not a chart here. Oh, it's 1 day. Be careful here. You have a lot of choices. So we have this 1 year deal, and you could see the volatility of Apple. Crazy, huh? Now, if we overlaid this to the S&P 500, you're going to see that there's no correlation here. There's some correlation, but you can see over the last year where Apple went through the roof, and then all of a sudden, what happened? It went from 260 down to 222. Well, that volatility could be, analysts are thinking that the sales of Apple products could be slowing, and subsequently there's a sell-off. One variable. Anyway, I could go on and on and on and on. And that beta will reflect, if this is a straight line of the S&P 500, Apple is going to be 1.24% more volatile than the market, okay? And then managing risks, I go over this again and again and again. You're going to see markets sometimes that are very turbulent, and you see this huge sell-off. Don't fall into the hype. Think long term. This is not a discussion for day traders. This is not a discussion about speculators. You can turn this off. This is not aimed for you. This is not targeted towards investment professionals that do this on a day-to-day basis. You, the average consumer, you want to look for a 30 to 40-year process. Warren Buffett didn't become one of the wealthiest individuals in the world overnight. He's 55 years into, 60 years into his investment strategy. He started in 1960. He's 65 years into his investment principle, long term. Okay, there's no reason for you not to trade when you see an overvalued or undervalued situation, but keep in mind, you're always looking long term. Also, you want to keep in mind your goals, emergency fund, and then always use this FINRA broker check. If you're working with a financial consultant, make sure they are who they are, and make sure if there's any complaints against them. This is a quick overview of volatility. I think if you look at the chart, you'll understand. Understanding why Apple's doing all this, you'd have to pay me a lot of money and I'll give you the reasons, but I'm not giving any investment advice. I'm just giving you an overview of what the analysts are saying. This is what I've read recently. Give me your opinion. Give me a reason why perhaps Apple is down from 260 down to 220. Give me an idea of why volatility is what it is. And then managing risks. If you're a speculator, this beta could be extremely high. All right, go back just 2 years ago. You're going to see they're called unicorn stocks, and they probably have beta values. They were growth. Those are 100% growth. You know they're not earning any money. But remember, Amazon 20 years ago was a unicorn at its infancy stage. I never thought a book company could be what it is today. And I shrugged it off. I made some rather nasty comments, and I put my foot in my mouth because, wow, had I just bought 100 shares, and it had a crazy volatility. It had this beta of probably 2.5. But now it's probably down to 1.2 or what have you. It's a mature company. But you as an investor need to understand what that is. And I'll have videos, and just always check up here on the right, and I'll have updates as to if it's applicable to beta, so on and so forth. Leave me your comments. Brad Williams, Frugal Finance, a quick overview of volatility and how it can impact you. Bottom line, long-term investors, don't get caught up in this hype. Don't sell when everybody else is selling. That typically is a buying opportunity if you understand the overall volatility issues that long-term, the stock market has always moved higher. Long-term, 30, 40 years. Brad Williams, Frugal Finance. Thanks for watching. See you soon.